Hello, good afternoon, ladies and gentlemen. This is a financial show on IBM Pod TV. My name is Sasha Starr, and I would like to introduce my panel for today. It's Nick Paliveda, founder of the network.
Sasha?
Okay, Peter Bennett, who is our regular contributor, professional from Wall Street. And finally, we have Milan Somberg. Welcome to the show, everybody.
Glad to be here. Thank you.
Okay, so today the major thing is that CPI number was released, and it's not very inspiring. On the other hand, it seems to me that it's based on somewhat fairly old information. So what's happening now, if I'm watching prices for different materials, and it seems to me the next month's number will be way much better than what's been released today. And in fact, probably market would agree with me because after initial shock and going down to almost 400 points down, it's now recovering. Tech stocks are doing actually quite well. They're weathering the storm. So it seems to me that market is still in an uncertain stage, but I think it's closer and closer to finding its bottom. And I think next advance will be in technology stocks, and they sound much more confident today, as not only today but in the last few days. And so, what would be the strategy that we should follow? Of course, S&P 500, I will leave to Milan entirely because he is an expert in that area. But I would recommend start looking at stocks that are not overly risky, selling puts, trying to acquire them at way cheaper price. A few stocks that I would think of, even Pfizer today, which is 51 some dollars a share. It was already at as high as 60 a few months ago. And I think one of two things must happen this year. Either they will buy their own stock or they will increase their dividends, which will be good in both cases, or one of the cases will be very good for stock. So if stock is 51, you can sell August, I'd say 45 put, because you will not collect a lot of money for that. So you must sell probably 10, 20 puts. Now, if your margin will allow you to happen, that will be all money that you will keep in a bank. Probably probability of that is way higher than 90%. Okay, Peter, now what are your thoughts about the market?
Okay, I'm going to start with all the news you need to know. And of course, the CPI, as you said, is important. So here's the chart. This does not look like it's going the right direction. This is from April 21. I'm just drawing in the last two. But you're talking about 9.3% now. Sorry about my logistics there. 9.1%. And I thought it would be high, but I disagree that it's going to go down. The trend, it's been going up almost, I think it's almost every month. For the last 6 months, it's going straight up. But so this is a big problem. Here's some quotes, and I call this section, something's got to give. And I think it's the market. I think the market is ignoring a lot of the realities. And partly, remember, the market is run by analysts who make money on the market and brokerage houses that make money on the market. So they don't want to see this. But, I mean, what I think is going to happen. So, first of all, Larry Summers said we need 5 years of unemployment above 5% in order to control inflation. We're nowhere near there. we're not even close. As a matter of fact, the last jobs report was 372,000 plus, and that is making it a tighter job market. But the job market only creates 75,000 jobs a month on average. So they're losing ground in the job market. There's huge demand for workers. Credit Suisse said it's very, very difficult to get a recession with job openings high, low. A recession is, in their definition, a contraction in the labor markets. So we already know that in reality, there was negative GDP in the first quarter, and that's another definition of recession. But the Atlanta Fed came out and said that they think that Q2 was likely negative 2.1%. So again, let's get back to the analysts. The analysts are forecasting, this shows you how rosy they're making it sound. The analysts are forecasting a 27% year over year increase in earnings in the discretionary sector. That's plus 27% year over year for the third quarter. Now, in the first quarter, it was minus 12. So maybe they're being a little too optimistic. I think they're being much too optimistic. Additionally, the consumer sentiment and small business sentiment is both now at historically lows. And some people might think that's contrarian, but I don't think so, because we have inflation problems that are going to be here a long time. So to sum this up before I get into energy specifically, the problem is the Fed would have to crush the economy to crush inflation. And I don't think they're willing to do it. But either way, if there's high inflation for years, and remember that 9.1, I have to point out, is a massaged number. In the 70s, this would have been 14% or somewhere around there, because now they're reporting both rental income and substitutions on goods in a different way, which the government dropped the inflation numbers. So this is tremendous inflation, but the Fed has to control it. But I don't think they're going to want to bring unemployment down up to 4 or 5%. So we're talking about a very serious situation. Oil dropped yesterday 8%. This is something else that doesn't make any sense. Oil dropped 8% yesterday, and the energy companies went down, although the pipelines, which I'm a big fan of, held their ground recently. But so Goldman Sachs, though, is saying this last week, they said Brent crude, which was at 120 last week, is going to average 140 for the summer and 135 next year. So this is a long way to go from 95 to 140, and that's an average. So that means it could go much higher.
Peter, hasn't summer already started?
What?
Hasn't summer already started? We're in the middle of July now.
Right. You're right, Sasha. So that
So
means
where is $140 price for oil?
Well, I mean, Goldman isn't always right, but they're pretty
smart. No, they're not always right.
I'll explain it. So
they're wrong much more often than they're right. Absolutely.
I don't know. But you know what? If they're right, and it's possible, and the market's got to be nervous about this, then it might hit $200 or $190.
Oh yeah, $250 and $300 and maybe $700 per barrel. But right now it's well down below.
Right, because the market is
and I don't see any signs that it will go higher.
Yeah, but Sasha, that's because the market's forecasting a recession that will lower oil demand. But it can't be both ways. If we're having a recession, that's going to be bad for the market. And if we're not having a recession, oil demand is going to stay high. But oil
Peter,
demand...
what kind of recession are you talking about when there are hardly any workers available for work? People are hunting for workers.
Look,
so there's a full employment right now. What kind of recession is that?
All right, so I'll interrupt the news and we'll discuss this, because I would have rather finished, which I could have done fast. But look, here's the thing. Something's got to give. How many years? Let's say I'm right, and I would have let me just cover one more area because it relates so much to what I'm saying. This is an energy crisis, or we're in huge energy crisis. So let me do the news on that. The president said this last week, this is what he said. He said, when it comes to gas prices, we're going through an incredible transition that is taking place, that God willing, when it's over, will be stronger, and the world will be stronger and less reliant on fossil fuels. So he's in a war with fossil fuels. This is what his head of his economic advisor said this last week. I mean, to me, it's a little surprising, but this is about the future. He's talking about high gas prices. He's asked by a stock analyst. He says, this is about the future of the liberal world order, and we have to stand firm. So from their perspective, well, before I get into that, so Christian Lagarde, who's the head of the ECB, said, I don't think we are going back to that environment of low inflation. There are forces that have been unleashed that we're facing now that are going to change the picture and the landscape within which we operate. This is Christine Lagarde. These are probably pretty smart people, even if Goldman Sachs isn't, and I think they are too. So the problem is the oil investment, which I pointed out a year ago, the oil industry is putting in 40% too little to keep oil where it is now. So supply is going to be going down. And for years, this is probably, Biden is not turning around and going to support oil. As a matter of fact, he came out with a plan where they're going to do no drilling in the Atlantic, no drilling in the Pacific, and possibly very limited or no drilling in the Gulf of Mexico. He doesn't care because he thinks he's saving the world by carbon. Now, I would argue the other way because carbon keeps going up because they're killing natural gas and people are having to go to coal and oil. So he's not doing a very good job of that. But the point is, this is a multi-year huge energy crisis, and the market's just beginning to realize it. Then you've got Ukraine. So China and India, this is news too. That's what I suggested last week. But China and India are actually, because of China and India, Russia's actually exporting just as much oil as they ever did. So what's happening is India particularly is refining the oil and sending it to the West. So these prices are not based on a shortage of Russian oil. But so India the numbers came out, they went from 70,000 barrels a day before Ukraine to 1 million barrels exported a day. So they're taking 1 million barrels of Russian oil and sending it to the West. So it's not Russia that's causing this.
So,
let me just point out one or two more things, then we can discuss it because this covers a lot of it. Although
almost half the show already over.
All right, well, that's because partly I was debating it, but
yeah,
okay. It's 112. It's okay. Anyway, look,
I don't believe in a scenario that you're painting that there is a shortage of oil while there is a recession, while I see no recession because people scrambling to find available workers. Now, Russia sells a lot of oil to India, as we know that all.
Right.
And the West doesn't care anymore about that because there will be a huge attack on Russians coming in about 2 weeks, and the war will be over in much less time than you think. It will be in 2 months. Yeah, the war will be over.
You heard that?
Oh yeah, HIMARS are doing their job there. In fact, Putin stopped any wartime activities until July 15th because there is no defense against HIMARS. So he stopped everything. He's asking Ukraine for peaceful negotiations, and Ukraine we don't see anybody to negotiate with.
Well, that would be very interesting prediction, Sasha.
Yeah, I'm following this.
But you know what? I just want to mention one of the next news I would have gotten to is that a retired general said that he thinks in the Wall Street Journal, he wrote an article, and he said the United States is intentionally basically providing only enough to create a standstill.
It's not true. He can kill himself for what he says. In fact, Ukraine getting so much ammunition and weapons.
Okay.
In the US, it doesn't have even enough capacity to store it all. They're playing theater carnival show. Oh, we are poor people. We need more ammunition. We need more weapons. They're getting as much as they need.
So you think they're going to actually push the Russians back?
They will push the Russian back, and it will happen in the next 2 weeks.
I hope you're right.
Attack, at least in south, they will hold their own on the east, and slowly they will prepare. As soon as the Russians will start move their army from east to south, they will attack east as well. So Ukrainians, they have 1 million strong army. Now they have the best ammunition and weapons from the West. They're fighters like nobody in the world. They are much more efficient than NATO fighters. And of course, if anybody can stop Russians, it's only Ukraine. There is nobody in the world can stop Russians. It's only Ukraine.
So are you forecasting the end of the war this year or more than a year?
In about less than 2 months' time.
Wow. That would be an amazing prediction.
That's a bold prediction. Yeah.
No, I'll tell you why I'm saying so. I was listening to a very trusted source that West is getting frustrated with the sanction against Russia. although they are working, but they are not working to such a degree and as fast as the West ever thought. Also, what West miscalculated is economic cost to the West to keep the sanctions going and adhere to them.
Yeah.
So once the West now realizes that, and they realize to see how the sanctions will function properly, and it will take another year, maybe a year and a half, and who knows what. But in 2 months, what could be over? All we need is to supply.
All right. So I have a question for you, Sasha.
Yeah,
which
sure.
is going to also be in my news. And I mean, I would, if I could cover it quickly, usually it'd be better than discussing each one because then I could get through it faster. But so in the news, first of all, Russia just suspended Nord Stream gas pipeline, which is a major source for 10 days. But Europe is very worried that they're going to extend this. And in the winter, what if they cut it off? So how can Russia lose? And maybe they can, but how can Russia lose when they could just turn the spigot and cut the gas off and freeze Europe?
I'm not talking about pipelines. I'm talking about HIMARS. It's a different story.
About what?
HIMARS is a highly effective weapons. They can shoot at 70 kilometers. Depends on the ammunition, and some other ammunition shoots at 300 kilometers.
But what if they start losing? Aren't they going to shut off the gas pipeline, or you don't think they will?
I don't think that Germany needs pipeline. Germany, and remember in 1941, did they have a pipeline from Russia?
No, but now it's a major source of oil. Russia's been supplying a major.
Well, Germans made mistakes. German makes mistake in 1914. They made mistake in 1941 or 39, give or take. So now they made another mistake. They are relying on the fascist regime in Russia to supply.
I agree with you that it's a mistake, but they've already made the mistake.
Well, it was their choice. They could build pipeline from Norway, but they are stingy little idiots.
But what about
pipeline to Russia? They will be punished. There will be no gas, no oil. So they will go to forests and they will chop the woods and they will hit their apartments with wood.
But Sasha, Peter, Russian oil is only one part of the equation. We have all the Mideast. Well, we also have all the Mideast oil. Where's Biden all this? Is he sitting in the United States or is it the Middle East?
There is no more Middle East oil, basically. I've covered that in the last week or two. They are not even producing at their quotas. And what they're doing is faking it, because what they're saying is we're going to increase our quota for every country, but they know a lot of these countries can't produce. So what they're doing is they're saying basically we're not going to increase it more. And why would they? Look, if oil is terminal business in 20 years or 30 years, they need to make a lot of money to reinvest in other things. You know, I mean, really a lot of money to make and to cover their budgets, but also, so why are they unhappy with oil? And they're not too fond of Biden either, especially Saudi Arabia.
Have you analyzed the critical points of support for oil? Do you know that it will go down to $90? The next support is 75, and it will break to 75. The next support is 52. So,
so let's say it goes to 75, Sasha. Then people are going to keep using more and more oil, right?
Next support. It's a next support, especially if there is a recession. There will be not much oil needed.
But there's a simple supply and demand curve. Either supply has to give or demand has to give, but supply is going down.
But there is a recession because you mentioned that there will be recession. You're saying that recession is imminent. If there is a recession, there will be much less oil required. So if there is much less oil required, it will go where? Down.
Yes, I agree. If we have a really severe recession, then maybe they can start to get inflation under control and, you know, bring it down to 4% or 5%, which is still crushing to the consumer over the years. If you look 5 years out, 10 years out, that's a lot of inflation.
Well, Peter,
but you're right. We might have a severe recession. I don't know what's going to happen. But we don't
know what's going to happen, but we know what is happening right now. The oil is going down for last month or so. With all the prices coming up to $250 a barrel. No, it's going to be $450 a barrel or so on. And I heard and I read all these materials, but the oil is going now, it's 90 some $5.
So you think oil is going right down? That's your prediction, Sasha?
Sorry?
You think oil is going down, and Goldman Sachs and I think it's going up.
All it has to do is to break down $90, and from $90 it will go down to 75 very quickly.
Good. You know what? I'm not an oil trader, but I just know I am an economist, and and based on that, I know supply and demand curves have to balance eventually. It may take a month, it may take a year, but remember too that we are taking 1 million barrels a day out of the strategic reserve to keep the price down. But they're using up the strategic reserve, not to mention Biden just gave 1 million barrels to the Chinese from this strategic reserve.
But you know what?
Which is unbelievable.
We are watching world prices for oil. It's a world commodity. So whatever Biden is doing, the world doesn't pay much attention to that.
No, but I'm just saying maybe he shouldn't be giving it to China. Just a point.
You can give it to New Zealand just as well, or anything.
No, it's different if you
what
give it to New Zealand.
What we know is a hard data. The hard data shows the prices for oil are going down, and they're doomed.
So what's your prediction for oil going down, and how long?
It will go to $90 in the next couple of weeks.
Oh, it might.
And
I have no problem with that, but I think by the end of the summer it'll be high.
Once they will break $90, there is no support until it will go down to 75.
So are you predicting 75?
Once it breaks 90, next support level is 75. This is exactly the law of supply and demand, and the chartists and oil traders.
It's not the law of supply and demand.
So what are your thoughts about the stock market in general in the next couple months? See, I have a problem.
Something at this point?
Yes, please address
it. What you've been telling us here, Peter and Sasha, has been pretty scary and worrisome and negative. So I want to inject some positive issues in here. People who have our philosophy of investing, and I'm talking about the Monday morning millionaire approach to investing, are just as happy to see markets drop as they are to see markets rise. When you take a look at headlines, constantly we want to see markets rise. Constantly, when markets are dropping, it's a negative thing. However, if the money which we're going to need in the next 2 or 3 years to buy groceries and pay the rent, if that doesn't belong in the market. So if we don't have that money in the market, and then we have a 50-50 asset allocation, and it doesn't have to be 50-50, it can be 45-55, 55-45, roughly speaking, 50-50, divided between the American market as represented by an exchange-traded fund which tracks the S&P 500, such as SPY. So we have 50% in that, and 50% in cash or near cash, and we keep balancing it constantly when market movements throws off that 50%, which means that every time the market drops, everybody's crying and running for the doors. We are buying bargains. And every time the market rises, everybody is jumping on board when they shouldn't be, an expensive market, we are taking profits. So people with our mindset don't have worries. We don't have money in the market that we're going to need in the next 2-3 years. We have a 50-50 asset allocation. And asset allocation is, to a greater extent, responsible for portfolio performance than anything else. Stock picking doesn't work. You're wrong.
Milan, I have a question then. What if the market keeps if it goes down a lot now, or what if it goes down steadily for the next 5 years?
Well, you have to take a look at history to see how frequently that has happened, and it's possible, but not likely. Okay, all right.
See this? That's your chart till November. What if it continues? I don't know if it will continue, but I think it probably will.
If it continues, the bargains will become greater. And if you maintain that 50-50 asset allocation and the market keeps dropping, you keep rebalancing your asset allocation, which contributes more to portfolio performance than stock picking does. Stock pickers are wrong half the time. They have to be. Mathematical certainty. Each transaction has a buyer and a seller. Only one of whom can be right. So let the market keep dropping. We don't have.
If the market drops, let's say you have $100 and the market drops 25%, you put some more in and now it drops another 25%. Now you have a lot of your money in the market, right? Because you transferred more of your cash to the market. But
you're always keeping 50-50, Peter, or your asset allocation, whatever it is. I choose 50-50 because it works very well for most people. So you're always maintaining 50-50. The market keeps dropping. You're maintaining that 50-50 and buying more bargains to rebalance that 50-50. Constantly, you have 50% in the market.
Peter, don't you think that what people actually allow to follow the strategies like in Peter described, the worst case scenario, the market will continue to drop for 5 years non-stop.
Right. Maybe.
So
it could easily.
Could it never happened, I would imagine, but let's see, theoretically it could happen. So in your scenario, you have probably high, well-worth individuals like dentists or lawyers or doctors who have a tremendous cash flow, which will never get deplete their cash assets. So whenever they will keep going from money market funds to S&P 500, so they will depleting their equity as the cash is concerned, but it will get infusion of the net income proceeds what they have as a professionals. So they will always keep rising as their cash reserves are concerned against S&P. So S&P, regardless how much they will transfer, they will have substantial losses on their stock account, but they will tremendous contributions from their cash flow to the money market funds. So this would allow to keep that equation almost indefinitely. So the market could drop actually 99%. It doesn't matter. So you'll buy all this S&P at practically neglected price because your clients, I would imagine, they have cash flow to sustain that policy. It's almost like Nightingale or martingale strategy in blackjack. When you
I was going to say the same thing.
Yeah, you keep like doubling and doubling and doubling.
Yeah. You know the problem with that though is
that once you go,
if you go on a long losing streak. I was going to say that exactly. That
and once you will lose once using that strategy,
no, but if you lose a long chain, if
165 years to get in.
So it gets ugly if you get a long chain of losses. We've already had losses since November that are substantial, but what if this chain keeps going? Look, I'm not saying 5 years, by the way. I just want to correct something. I just know I think it's very likely to go down. It might go down 60% or 50% now and then very slowly recover. But either way, something's got to give. You can't have massive inflation, low interest rates, low unemployment. So either inflation will continue, which is, I think, the most likely scenario, which is not good for the consumer and not good for the economy, or they're going to have to crush the economy with high rates, which is going to also cause problems. So there's a lot of problems on the horizon, and I don't see them getting solved for many years.
One of the great protections against inflation are solid assets like owning a piece of productive capacity, such as a stock, which is invested in productive capacity. The stock market has consistently been a great protection against inflation.
Actually, it depends on the sector. If you look at
we don't buy sectors. We buy the American economy as a whole. You're going to be wrong with picking sectors. You'll be wrong half the time. No. The greatest beneficiaries of inflation are borrowers. The biggest borrower on the planet is the United States. They don't have a whole lot of motivation to tame inflation, even though they have to say that for political reasons. Now, people who have our mindset, let's take a look at today's Wall Street Journal headlines. I'm looking at one which says, stocks fall as inflation accelerates. Today's Wall Street Journal. Right. Stocks fall. We are buying bargains. We love it.
Wait. But Sasha would say the market is efficient and the market's doing the right thing. And you're telling me the market's doing the wrong thing. You're saying inflation is high and it keeps getting higher, but the stock market's going down, but the stock market's wrong and it's going to turn around and go up a lot. Maybe. I don't think so.
Sasha is right. Sasha is right about the efficient market. That is, Peter, you talked about a bond portfolio dividend portfolio that's returning 13% annually previously. You talked about that?
Not exactly, but
some stocks.
Yeah.
I have some stocks that are high dividend stocks.
Yeah.
The other stuff I keep in bonds.
High dividend stocks. Totally answer. You know the dividend aristocrats? Have you heard of the dividend aristocrats?
Yeah, of course.
Yeah. Okay. So those are stocks that have been paying an increasing dividend for more than 20 years. And there are only about 10 or 12 of them. And when you compare those to owning the S&P 500 during that period, the S&P 500 would be ahead.
Because of tech. Because of tech is up 20 over 25%. Tech has done great in the last years.
Okay,
but now tech is not doing this great. You know what this chart is? What's very interesting is this is NASDAQ and this is the S&P 500. And you know what? The movements are almost identical.
How old is that chart? I'm taking
this chart is through this week. I just printed it out today.
I'm taking a page from your book, Peter, and going to start showing.
Okay, so what's that chart?
So that shows. Have I got this correct?
All right, dueling charts.
Yeah. It shows how much the market has dropped today, which is
that's a long-term chart, right, Milan?
Yeah. So no, this is the long-term chart. This is a 20-year chart.
Okay.
Which shows the market going up. Have I got this turned around?
Well, let me play my ace. This is my 40-year chart.
Yeah, in the 20-year chart.
This is my 40-year chart of interest rates. Look at what happened since 1980. Down, which is, by the way, why I like bonds a bit now, because I think it's going to head to zero at some point. But for 40 years, the Fed has been lifting the market by bringing down interest rates. But they can't go below zero. And even now, they're under pressure to raise interest rates because they have to fight inflation. The cat is out of the bag. They're
not highly motivated to fight inflation. So, like I was saying, well, let's take a look at our.
Well, let's say they don't. What happens then, Milan? What if they don't? You see, this is one or the other. Either way, let's say they don't fight inflation well. What happens?
By owning
inflation,
by owning shares in the stock market, you're protecting yourself against inflation. Yeah.
It depends on the companies, I guess. You know what? I agree with you to a point. There's certain stocks that I like, and Sasha likes too. Maybe a Pfizer I like. You know, certainly an MLP I like. Certain companies I like. But you know what? Besides tech, there's a large consumer discretionary part of the S&P 500. So yeah, it's a simple strategy. Buy the S&P, buy more S&P. If I'm losing, buy more S&P. Like you said, it's like blackjack. What happens if the S&P keeps going down for 10 years? Your strategy doesn't work well. But let's say it doesn't go down. You're still buying every company. It's simple. And it may work for some people if you don't want to spend any time watching the show or spending any time on your finances. But I think for most people, it's worth the time to spend to learn about the markets, because you can do much better than buying consumer discretionary in a market where inflation is going through the roof and people aren't going to be able to afford consumer discretionary.
When you say it may work, studies which were published in peer-reviewed journals, academic journals, show that picking the United States economy as represented by an exchange-traded fund which tracks S&P 500, that you cannot beat them over the long term. You can teach a high school student in 15 minutes.
We've been through this. Sasha and I beat them. I beat them very handily. And you know what? I agree with you. There will be a time when I see things, when the market realizes that there's a problem. The problem is probably inflation that's entrenched, or that the Fed has to raise it to crush it, and either one's not going to be good. There will be a time to buy the S&P 500. As a matter of fact, I am waiting for that time, because I like the idea of getting into the market as a whole.
It's down 20%. It's down 20%, which makes it a bargain.
What?
You go to a store and it's down 20% as of today for the year.
You're at the blackjack table and you lost 2 hands. Does that make it? This is time to double? Maybe.
It has some similarities to blackjack, but not altogether.
No, it is. This is not guaranteed money. This is gambling.
Well, no, it can be, but it doesn't have to be. So Sasha was
not guaranteed. If it's a guaranteed, then it's called a CD.
Sasha was talking about how our members, Monday Morning Millionaire, are mostly professionals, data so people with high income, so they can keep pouring money into the market. That's called saving. So we're not talking about saving here. Saving, by the way, is very important.
I'm a big advocate of saving.
Yeah, of course. I mean, it's critical. If you don't save, nothing else works.
Right.
So, but you're talking about saving, Sasha. It's possible for people who have an income. We're not talking about saving here. We're talking about holding the U.S. economy, the strongest economy in the last 200 years. And yes, empires have a 100% failure rate. But the failure of the American...
I'm not betting on the U.S. failing. And also the S&P 500 has a big interest in... They may be U.S. companies largely, but they have a big interest in Europe and China. there's a lot of exposure foreign just by getting the
You take a look at any major company.
If I want a company, I want one in the U.S. By the way, I agree with you and I disagree with you because I love U.S. companies. I only look for companies with very little exposure or no exposure. I want zero foreign exposure in this economy because you know what? If there's a problem with the economies of the world, with inflation or recession, whatever, the other countries are going to have much less wealth. Europe is in big trouble. Japan is in big trouble. They are very dependent on energy. Europe could have they're probably going to have a huge.
We absolutely need to disagree because if there's total agreement, there is no market. You have to have opposite views in order for a market to exist. So I
agree with that.
Agree with me.
People have different degrees. You know what? So far, we've had this. I marked the date. It was late June, and so far, my strategy was don't buy the S&P 500. Your strategy was buy more of the S&P 500. And I said, we'll see what we look in December. So we will see, but I would not bet against me.
I have a standing $100,000 bet, Peter.
Yeah, with what?
Payable by the loser to the winner's favorite charity, saying that whatever you are doing will not equal the S&P 500 over a 15-year period.
15 years.
Yeah, that's right. You're welcome.
Well, unfortunately, if we're both alive in 15 years.
Oh, no, listen, if we die tomorrow, our estate should be alive.
Yeah, but I won't be able to. I'll probably be able to collect, but we never know. I hope I'll be able to collect, but I'm getting up there, and you're getting up there. So 15 years is not my time frame. You know what?
No, it's not
my time frame. Sasha's time frame is 1 week, right? You make your money in a month, a week with the options.
Peter, that's
my time frame is I want to make money this year. I don't want to wait 15 years or 10 years to find out. I want to make money this year.
Peter, everybody wants to make money this year, but that's not possible.
Oh, really?
There is no ideal investment. Actually, the only ideal investment is to keep working.
Well, my portfolio from its high is down about 5% since the very high. But I think that 5% is grossly undervalued. In other words, you have things that are, if you just adjust it, because the companies I have are doing better or the same. And so if they just added the value up, plus my losses were mostly in bonds and Amazon, which are, I believe in totally in the long run. So basically, I haven't lost any money. But here's the difference too. This is a very key difference. If you're a dividend investor and you have dividend stocks, it's a lot easier to just hold. Because if you're in the S&P 500 getting a very low dividend, maybe 1.4, whatever it is these days.
You're not in there for the dividends. You're in there for the growth.
I know that, but that's the point. So now you see your portfolio drop 30%, 50%. The reality is, you're going to probably say, wait a minute, I need to live on this money. I'm going to sell. I'm going to retire.
You shouldn't. People who need to live on the money in the market are making a mistake because...
Well, eventually people want their money, whether they want to live on it or not. But
someday for sure they will be selling at less than they bought in order to buy groceries.
Yeah, but with a dividend stock, it's different because let's say I'm getting the 3% dividend that's growing or a 10% dividend or an 8% dividend. Then I say, you know what? I have a business that's generating cash. I can live on the cash the rest of my life. And I've got a growing business.
The dividend aristocrats, which have been paying to qualify as a dividend aristocrat, you have to have a company which has been paying an increasing dividend for more than 20 years. There are not many of those. There are half a dozen, maybe.
You just said it. There's not many of those.
Exactly. So now let's say you put together a portfolio of dividend or aristocrats, and that's not a difficult thing to do. You know which ones they are. That has not matched holding the S&P 500.
Yes, but you're looking backwards at a tech period where you're looking at two things that may have changed. Tech grew tremendously. Tech is still going to do okay, but
it's inside the S&P 500.
But tech got very, very inflated, as we see now. It's dropped. I mean, I think eventually a lot of tech will grow. Other tech won't do well. It depends on the company. Netflix has been a disaster lately. And that's tech. I don't know. I don't think it's in the S&P 500, but I'm just picking it as a company. But you know what? But the thing is that you have also the Fed has been inflating the market. But here's the difference. And this is, I'm going to cite this. Then we probably have to get into dividend stocks. We can argue about this forever, probably. But look, 20 years ago, I read in Barron's a study. And this matches the study. So they said that when the population over 50 when the population under 50 is growing relative to the population over 50, the stock market does very well. But in 1,000 years of history up to that point, and they got 1,000 years out of Japan, England, and the United States, 1,000 years, there was almost a 1-to-1 correlation between when people over 50 are growing rather than under 50, which now we've reversed, and we're reversing more and more every day. The stock markets went down, and it was almost 1-to-1 correlation. Now, that hasn't been a perfect correlation for the last 20 years because the Feds keeps cheating. And, I don't mean literally cheating. They keep dropping it. But look, I have 1,000 years of history that says that a lot of boomers are going to retire, and they're going to need to spend some of their money. And they're also going to get very conservative about the stock market because they're not going to like losses.
That might explain the Japanese market. That about 30, 35 years ago, the Japanese market was at its peak. 39 years later, it was at half that because they were a growing population. So that may explain the Japanese market.
Well, but you just made the point. What if that's what's happening in the United States now? It used to be, it's probably higher now. It used to be 10,000 people a day were retiring. It's probably higher now. 10,000 people a day. Those are the people who are going to say, I need to make my portfolio safer. Maybe I take my 401k and say, instead of 90% stocks, I'm now in a different period. I need to protect my money because I need to live on it. And I'm going to spend some of that money before I die because I need to live on it. So money is getting spent now by people who have a lot of money. So this is not good for the market. And I'm not saying it's going to be down always. I mean, look, if the market gets to an acceptable point and the market realizes that we're probably in a 5-year period of inflation or 10 years like the 70s, look, there was a great time in the 70s to buy the stock market. It just wasn't today.
Peter, suppose that all the immigration and emigration barriers on the planet were eliminated and removed.
Here they are.
Where would most people go? Would they go to Albania? Would they go to Rwanda? Or would
we've got huge immigration in the United States.
Australia. And so it was very easy. United States in North America was built by immigrants with the greatest energy and courage to leave the environment that they were in.
I agree with you. That should help a bit.
America, where they couldn't speak the language and they the diet was different and everything was new. But they came, those were the most courageous and the bravest people. People with the best brains came to North America. So North America, where was it 300 years ago? And
you're right about immigration in the very long term. But the thing is, right now we have a lot of illegal immigrants coming in. Some of them are going to become workers, but they're not going to be high saver workers and high stock market investor workers. They're building a life. So their money is going to go towards educating their children. Their money is going to go towards food and clothing. And if anything, for the short run, they may be a burden on society because they may take some of the benefits, And also, by the way, that a couple million people is helping raise inflation because they're going to consume gas and they're going to need apartments. But beside that, in the long run, in 100 years, those children will probably invest in stocks. And you know what? At some point, the population will shift again and people under 50 will hopefully grow. But this is not the trend right now.
I want to draw your attention to a book called None is Too Many. A Canadian cabinet minister in 1947 or so was asked, how many Jewish people should we admit into Canada? And he said, none is too many. And that was the title of a book. Now, we had a minister of immigration, Ron Atke, I think his name was, in the 70s, who, having read that book, said, that's astounding, that's criminal. We're going to allow these Vietnamese refugees into the country. So he allowed some 70,000 Vietnamese refugees into the country. And I had about 20 of them to take our implant course. And every one of those has become a dentist, an accountant, a lawyer, and they are paying income taxes to a far greater extent than they did when they were refugees. Yeah, when we came to this country.
But I don't think that's going to happen with the 2 million people a year who are coming in from over the Mexican border right now.
Milan, what you're saying, there is a lot of similarity between Vietnamese refugees and Jews, because the Jews also have a lot of lawyers and accountants and other professions.
All right, you know what? We've got to wrap it up, unfortunately, but we can continue with this part of the discussion. I also, next week, I want to discuss Elon Musk, who said he wants the population to increase.
That's interesting,
He wants it to increase, and I never got to that because that would have been the last part of my news. But so just dividend stocks super quick. For the first time since the show began, since last year, I'm not giving a specific dividend stock because I don't like the dividends at all, but a few things. EPD, one of my holdings for about 3.5%, 4% pipeline, increased their dividend 2.2%, which was a nice little jump. BSM, which is Blackstone, I actually reduced from 1.5% to 1.5% because I have it in an IRA, and I didn't realize, but because they do so much hedging, they could have what's called UBTI, and I could get actually a ton of taxes on the BSM. And I hold a lot of my MLPs outside, but that one I was just holding inside because I didn't want too many MLPs for accounting purposes. And bonds, because of this, whichever the chart I showed before, because the trend line is towards zero, because the Fed will eventually stimulate the economy again. Because what's going to happen is inflation is going to crush the economy probably so much that they're going to need, once things adjust, unemployment goes up, not to mention the robots are coming, and that's going to be very deflationary, extremely. You should see the article I have about robots, but I didn't get to that. I wasn't going to get to it this week. But so eventually rates are probably going to go down to zero. That's when the stock market will flatten forever in our lifetimes, or 10 years, because then at that point, rates will be low, the Fed won't be able to stimulate it, and everything will be going on. And plus, this energy crisis is probably going to take years to solve. So I like bonds. I like them. I got a bunch of bonds at 3.5%, some tax freeze, and some others. I even bought 40 treasuries for till 43 or 47 in my IRA. And you know what? I may lose a little money there, but there's no bad bonds. There's just bad prices. So either way, I get the income from it. Maybe I could have gotten a higher rate, but at this point, I don't mind the diversification of owning some bonds as a diversifier.
So Sasha, may have 30 seconds. This show is about to wrap up. So 30 seconds, what I'd like to say is, Peter, Sasha, and Nick, when you are right, I agree with you. But when you are wrong, I cannot.
Fine. We'll see in December.
That makes a lot of sense. Absolutely.
Wait, in December, if we're down another 20% or 10 or 15 or 20, are you going to say maybe you're right? Or are you going to say, no, we'll just put all the money back in there and in 15 years, I'll be right?
Okay, is that we will end our show for today. Thank you so much for being with us, and have a nice, good, prosperous week in trading or investing. Depends how you call it.
Right.
See you next week. All the best to you.
Thank
Bye-bye,
you.
everybody.
Thanks.
Thank you for having me here.
Thank you.